Money day, guys and girls. Hope you lot are blessed. Welcome back to another video. You're here learning with Vel, and in today's video I'm going to share with you guys how you can use the Fibonacci tool effortlessly and perfectly when it comes to identifying what's a valid Fibonacci swing and an invalid Fibonacci swing. I'm going to be sharing with you guys my secrets, my tips, and also my numbers. The numbers that I use for my Fibonacci so that you guys can use it too. Now, of course, I've got a mentorship program. I've got an online video program, okay? Both courses, whether you're learning from me in person or you're learning from me via online on my pre-recorded videos, they're going to go into far much more detail when it comes to understanding this exact tool that I'm about to teach you guys in just under 5 minutes. So if you haven't already, I'd appreciate a smash of the like button, a subscribe if you haven't already. And of course, I told you guys who are inside my Telegram channel, if you're not there already, click in the description links. You guys can get access to my free Telegram where I give out free trades. I also give out educational tips, advice, information on various different things. But I told you guys I'm going to be releasing 3 videos that's going to help you guys get access to my bot. For those of you who don't know, who is completely new to my YouTube channel, I have a bot which is amazing. This bot pretty much is a printing machine. For those of you who are unaware but interested, go in the description below. This isn't a promo, just go in the description. I've got a free bot Telegram channel. You can see what the bot's doing for hundreds of members and what it has been doing. But today is going to be the day, guys, that I release a letter, which is going to be a 3 video clause where I'm pretty much going to release 3 letters, 1 in each video, and whoever can contact me telling me what the 3 letters spells, you guys are gonna get this bot for free. Okay, so enough chatting, enough mumbling, enough rumbling, let's get into this. Okay guys, so we're gonna start off by sharing with you my Fibonacci numbers. This is gonna be the most important part. So as you can see here, these are the numbers. Take a screenshot, guys, and make sure all of your settings are exactly like mine, okay? So, wasting no time whatsoever, we are now going to have a look at what can make a Fibonacci swing valid or invalid. Now, what's really important here, guys, is to actually understand market structure. If you can understand market structure, then it's going to help you understand when a Fibonacci swing is valid or invalid. So for instance, with a Fibonacci swing, okay, we need to make sure that a structure has been broken in order for us to use the Fibonacci. The Fibonacci is being used for a pullback measure. So all we're trying to ascertain when we use a Fibonacci is where would be entries, where would be areas that we can focus on entering the market. So for example, here we had price push up high, price came down and price pushed up again, but price fell to make a new higher high. Right? So the structure on the 4-hour started to change here. Now, this is the last higher low that was valid. So when price is pushed down beneath this higher low, we now have a break of structure. Therefore, I am now going to measure from this swing high down to this swing low. Right? I'm going to measure from this high down to this low. Now, pay attention, guys. When price pushes back up, we are going to use the 62%, the 70%, and the 79% as our prime time entries. We want to look for multiple confluences within those numbers. So if we can find equal lows, equal highs, session candles, if we can find institutional candles, or like what we see here beneath the 79%, we can find an institutional level. If we can find multiple things to help us have a extra, we call it multiple confluences. If we can have extra reasons for confirming the reason why we want to take this trade, that is going to give this trade more of a probability to work in our favor. We can also see up here, price has pushed up and filled the imbalance. So there's multiple reasons. At the moment, we had a structure break. We had price push up, fill the imbalance. We had the institutional level here, and we also had the Fibonacci, of course. So we had 3 to 4 reasons why we would take this trade. And based off of that, guys, what I want to show you guys now is gold dust, okay? As price is coming down, our first take profit target is going to be -14 to -27%. That's going to be your first take profit target. What you should do is look within this range between -14 to 27. Look within this range to find reasons as to why you would close this trade. Can you find liquidity in this area, equal highs, equal lows? Find a reason why you would take profit in this area. The second area is going to be the -127 to -141. That is going to be the second area. The third area is going to be the minus 200 to minus 250. All you need to do is find reasons why you would take profit inside of these areas. Now, of course, as we look to the right, we can see price comes down. It plays into the minus 141. Price then pushes up, okay? I don't think price comes as low as minus 200. It comes really close though. Oh, look at that. I'm wrong. It comes way past it, okay? It comes way past the minus 250%. And that's great for us because all that's showing us, guys, is that time is more important than price. So what I mean by that is when you get into a trade, you have to understand that you're not just trading. Some of you are intraday traders. Some of you are scalpers. So this strategy that I'm teaching you can be used on any time frame. But for those of you who like to hold trades, who like a bit more maybe stability, who like to look at trades from a longer term perspective, using this off of a higher time frame is just going to teach you to become more patient, which means you'll become more precise, which means you'll also become more profitable. So to reiterate, in fact, what I will do is I'll go on the 15-minute time frame, okay? And I'll go on another pair. We'll go on something random. We've got a minute left because remember, guys, I want to show you this in under 5 minutes. So I'm going to show you this again now on a 5-minute time frame. As always, we can see here, here's a new high. So we're going to mark this. Swing low here to swing high, okay? Swing low to swing high. Now, we can see here when price comes down, it's come down to the 88%. Guys, we want to see price wicking off of the 88% area. You don't necessarily have to take that trade off of the 88, but at least let price wick off of this area. Once price starts to do that, you've got from price reacting off of the 88, and before it gets to 62%, you've got all of this time in the middle here to get into the trade, right? So we see price wicks the area and pushes up, it comes down, it pushes up, and then it comes back down eventually here, wicking the 70 to 79%. I want to let you guys in with a bit of a secret here. We're over time, so I got to go. But I want to tell you that the 70 to the 79%, that is the G spot. That is the area where the magic happens, guys. Now, of course, once you get into a trade around this area, the first thing you guys want to do is let price make a new high. Okay, once price clears above this previous high and it goes to the minus 14%, you have to think about your risk to reward ratio here. I personally will always have a minimum of a 3-to-1 risk to reward. If we got in at the 79% and price has come all the, and my first TP is up here, my risk reward is always a minimum of 3-to-1. Now, of course, on the 15-minute time frame, guys, you may not need to have such a wide stop loss. In my personal opinion, off of a 15-minute time frame like this trade in AUD USD, I just kind of want to make sure I cover this candle down here, okay? I want to cover this black candle that price is actually playing out of, okay? As long as I cover this candle, then I'm not going to be too ashamed of price going against me. If price does go against me, then it shows me that actually price is not ready to react out of the area that I want it to. So this is a 10 pip stop loss. We can even just come down a bit more and give it 11 pips. And of course, price pushing up here, this is a 4-to-1 risk to reward at the moment, guys, okay? And that's just providing price comes here, okay? If price then comes to our second entry, we now have a 9-to-1. And if price comes to our third entry, we've got a 12-to-1 risk to reward. So you can see, guys, how just by understanding how to use the Fibonacci, it can help us become more profitable and more patient. Remember, guys, when you use the Fibonacci, you're not using this tool, okay, purely by itself. You have to use this tool as an addition to other things you've seen in the markets. And that's why I referred to you guys, that's why I referred market structure as the most important thing. Now, of course, this was just a brief introduction how to use the Fibonacci. I hope it's helped. Like I said, in my mentorship program, I do cover this in a lot more depth, but I wanted to give you guys something short, brief, within 5 minutes, so that you guys could, of course, understand this. Let me know in the comment sections if this made sense. Let me know how you guys would like me to maybe do different videos. And of course, as always, be sure to smash the like button if you haven't already. I appreciate you guys' support. It's going to be a very interesting week, and I look forward to seeing you guys on the next episode. Peace.